Junior mining companies developing mineral deposits across Europe are playing an important part in securing the future supply of critical raw materials required for energy transition. The speed of turning geological finds into fully operational mining and metal production depends on collaboration with the financial markets. The European Union, which recently unveiled its Critical Raw Materials Act, has urged European financiers to provide more funding to mineral suppliers. Traditionally, European banks and investors are being criticized for being too slow to finance mining projects because of red tape linked to environmental, social, and governance requirements. The funding approval for a mining project can take months and even years. In their defense, the banks and institutional investors are experiencing mounting pressure from social activists and other stakeholders who are urging them to reconsider their approach to financing mining projects and to do more to reduce the demand for critical raw materials. Our expert panel will not only address these critical issues, but also provide invaluable insights into attracting funding to supercharge exploration activities in European regions brimming with high exploration potential.
Okay, ladies and gentlemen, good morning again to that second panel called Mining Unicorns in Europe, which is something we can discuss an hour alone about, if they will ever exist or not. However, we have a group of investors and projects here in Europe, and we have as our main speaker Gareth Taylor from S&P Global. I think you all know the company and leading data provider for our business. And he is responsible for the business development in Europe, Middle East and Africa. And I think we start with your presentation first, and then we go through the audience, and then we try to enlighten you a little bit how to invest in Europe, if it makes sense or not, and try to find some results.
Thank you very much, Stefan, for the introduction. And so, audience, ladies and gentlemen, and all the presenters, indeed, you've had a lot of very insightful presentations and discussions, so I appreciate all of that. Yes, as what Stefan said, I think most people know the company S&P Global. Market intelligence, I work with the mining sector, we have research, we literally do exploration, development, operating assets, and provide news and research within the industry, all in our CapIQ Pro platform. But yeah, I want to just touch on a few of the data sets that we have that fit with this discussion, fundamentally covering the impact of energy transition in the metal sector, and looking at key trends, look at mostly like exploration and finance and sort of performance and strategies of asset managers. So I think it's clear for everyone already, really the largest challenge, one of the largest challenges to reaching net zero is resourcing metals that are critical to metal-intensive energy systems, ramping up renewable energy generation, improving infrastructure to deliver that energy to consumers. That would be in far reaches from the sources of the energy, and of course energy storage for consumers are not using the energy, the transportation, where you need high energy density batteries to achieve range. With a lot of Western governments have now realized the extent of this challenge and approaching policy to develop with the intention of facilitating investments, to find resources, to improve processing, ideally closer to home. That's not always possible because resources are bound by the Earth's geology, and if you want to ship it across the world, you're going to see a lot of additional carbon emissions with that. But we're seeing those changes, and China's been doing this for many years already. So you can see Western governments a little bit behind this. And I'd like to first start with this report, it's an IEA report done in 2022, and I thought it's really nice. It illustrates, what's going on here and identifies not all, but some of the critical metals that are needed for power generation in comparison to coal and gas if we're shifting into renewables. And of course into electric vehicles if we're shifting from the combustion engine. This focuses on long-range EVs. And I think it's important to note that technology will continue to enhance and changes will happen. Price sensitivities will affect what technologies are taken up. So these numbers will change. That's understood. But considering the sheer volume of how much that needs to be built, how many new electric vehicles, how many batteries that are needed to serve that whole industry, the question of which technology will dominate is less relevant. The sheer volume means that all the metals are going to be needed to feed a little bit of all the technologies. There will be a composition, let's say your anodes and your cathode types might change. China uses lithium phosphate ions, which are a little bit cheaper at the moment, while the West look at high nickel cathodes fundamentally. And mostly we're using graphite anodes. This might change. And hydrogen might play an important role. Silicon anodes and solid states batteries might take up a bit of graphite. So all this will happen, but in the future, all these technologies will have a place to play for us to reach net zero. And the second slide just puts this into perspective, again from the IEA report. There are two demand scenarios, net zero by 2050 and a sustainable development scenario, which is basically meeting the Paris Agreement goals. What's interesting is the minimum, 4 times the technology demand. So it's a quadrupling the technology required during this period of time. And on the metals, you can see they say 42 times for lithium, graphite 25, cobalt 21, nickel 19, and rare earths 7. So all these metals are really, really looking to expand the consumption in these, within this industry. So I won't go into all of them. Our research, we estimate a deficit for a number of key metals: copper, cobalt, nickel, lithium. These are some of the key ones that we do our internal research for. And by 2027, copper will be up 15%, cobalt 25%. Nickel's flat during this period, we see, but lithium is down 30%. And that's primarily because prices are quite high right now. I think last year, a lot of the new production was delayed, and so we had a price hike last year that's still slowly coming down. But I want to focus on copper. Copper has limited substitution, until we can realize low temperature pressure superconductors, which there's been some talk of new findings, but nothing concrete. But copper is 2.5 to 4 times the copper required in a combustion engine, and up to 5 times per megawatt for offshore wind. So comparing with these traditional technologies. And so our demand forecast, we estimate copper consumption specifically from energy transition, rising from 31% to 42%. And I want to just show some of the key drivers, which is the next slide. This is compounded annual growth. It's in double digits for all these technologies. If you put transmission and distribution together, that's 10%. It's over 20% for offshore wind and electric vehicles. This data, by the way, this comes from, this long-term forecast comes from IHS Markit, who are now part of S&P Global, and our research team look to collaborate with our in-depth metal research and asset-level supply down dynamics with some of their economic and long-term forecasts. So this was summarized by our teams in these two charts, or this chart on the right, which just shows your copper consumption per capita escalating till 2035. And so you see here that the energy transition technology is outpacing that of traditional technologies. And up until the point where infrastructure starts to tail off as we built most of the important infrastructure that we need for energy. And at this point, copper demand will double
we could hit 50 million tons per annum, double what I think we had in the last few years. And just to put that in perspective, we over the last 35 years, we mined about 500 million tons. So, we're going to mine that in 10 years from 2050. Our reserves are about 15 years at the moment, the life of the reserves that we have with current rates. And if you add your resources, it's going to go up to 35. So that's only 35 years if we use current production, if we can mine everything that we know about. So once you double this, you're going to halve your life. And my colleague yesterday, he pointed out that our research says it takes about 15 years from discovery all the way to production if it's a major asset. Like an Escondida size, El Tiente size. These are the assets that we need to find. And if we don't find them, we won't get the copper. If we don't get the copper, we're going to fail in our net zero target. And that's going to happen, I focused on copper here, but it's going to happen across all of these metals. So they all need to be found in the short term to achieve that. And I think the last day or so, I think a lot of the discussions about, all right, yes, we need to do it, but how? I'll just finish this last slide on copper. Just shows you the supply gap. So there's two scenarios. There's Rocky Road, which is basically, as we've expanded, the trajectory we have right now, it's unchanged. And then ambitious alternative, which is, better recycling, increased production, increased utilization. But even this kind of high ambitious, you'll notice that line here, it's over 1 million tons in deficit by 2035. It's larger than the largest deficit ever experienced back in 2004. And that time, prices increased by 61%. So where we find ourselves in 12 years' time, that depends on everyone today, from investors and consumers. Are we redirecting investment into R&D? Are we looking at higher risk, exploration? And governments facilitating investments, whether it's tax incentives, cutting red tape to the developers. And a balance must be achieved here. Of course, we don't want to damage the environment too far as we do it. But yes, now we'll shift into current trends. And there's some promise. It's still a difficult situation, but it does show some promise in the industry. And I'll go through what we call our state of the market. It comes out every quarter. There's a few slides, a few of the data points I'll use from it, as well as our exploration spend data. And then just to introduce, obviously, we think people have been tracking the news, but we know China's been struggling with debt crisis, hits their property market, the property industry the hardest, and several related metals have been taking a hit. So there's a lot of forecasts have started to come down because of that. At the same time, inflation has been eating into all the miners' profits. As I said, we do see a rising investment in resources, right, despite these headwinds. The biggest issue, I'll point out, is really in the junior sector, where junior exploration is struggling. We're struggling to reach funding. Still spending, but we will certainly see their spend start to fall in future as a consequence. And I think that is the biggest issue that needs to be addressed. Right, mining performance. Market cap, you can see in the bar charts, started to fall this last quarter. That's 23% drop from Q1. Right, Q1 was a nice bit of optimism. I think COVID was being relaxed in China, the COVID restrictions, so that was giving us a boost. But that was overtaken by some of the debt issues that we see in the property sector. So economies are starting to struggle. And we track what we call the pipeline activity index. That's the yellow. That's the yellow you can see. That's actually been coming down pretty consistently. Right, and that is indicating that there's a gradual slowdown in new projects, new finds, new exploration. And that's due to this historical poor investments. The pink line, that's actually our exploration price index, which has picked up a bit. That's mainly gold. Right? Obviously, during times of economic uncertainty, gold's prices start to pick up. So that's what that trend is saying. And we look at financing. There's hard to read that, but maybe you can tell that since 2019, there's been a gradual trend downwards there in the recent years. And it was only this year, you can see the first quarter 2023, where the boost started to return. And that was a 76% surge. So we went to $11 billion, right? That's a big increase. 65% of that were juniors, intermediates. So, it was looking strong this year. And Q2, as you'd expect, it's dropped a little bit. But, what I find concerning is, only the majors, you can see majors there in red, they've continued to grow, right? They're up to 44% of all capital raised, where the juniors and intermediates, and you can see most of that history, they've struggled to raise money. And this is conservative financing, right? It's been prevalent for the last 10 years. And what that means is that the juniors and intermediates, they struggle to raise financing. Interest rates are now much higher. It's much more difficult to raise money at attractive investment terms to invest into high-risk exploration. And I think I guess some of this has been given a lifeline with more creative agreements. So you can see companies that are higher risk strategies. They might look at optionality to buy into exploration if they are successful, or royalty streams in the contracts. And strategic investors, so those are companies that start looking upstream and start securing their supply chain. And that's been needed, and for those involved with the graphite market, there's been no debt funding unless you're, or very little, but it's going to be those strategic investors that you look to get those things moving. So next we'll just strip out majors. Same chart, same data, it's just the juniors and the intermediates there. More interesting is on the right, if you can see these bar charts. There's only a few markets that are actually benefiting. It's all in the specialty group that we label. Lithium is top. It rose $44 million year on year. And the other energy transition, actually interesting, you can see copper, nickel, graphite. They're not been doing as well. So, it's not necessarily just being a battery metal and energy transition means you're going to get funding. And what that means is, kind of mentioned already, but once your resources start to dry up, right, we'll struggle to replace them. And it's these smaller players, the juniors, the intermediates, they're out there finding new greenfield projects that are the ones that are needed to find new discoveries. So we'll look at the next slide, which is exploration budgets. So it's mainly to say that these juniors, despite these headwinds, despite struggling with raising finance, they are still spending money, which is good. This is our global exploration trends study that comes out every year. So it's 2022 there, and in fact, last week we just launched 2023. Not quite in time for me to put the chart in here, but I can comment. So since 2012, you can see in the little bar chart at the top was the last high that we had, and since then, exploration budgets has been dropping significantly. It rebounded back in 2016. That was the lowest in this chart, and you can see how it's been picking up quite nicely since then. COVID having the biggest impact in 2020, but the trajectory is pretty good. And we reached a 10-year high. Last year, that's $13 billion. That's the little red bar you can see. This year, the latest is 12.7. So not as good, but still pretty significant. So it's good to see exploration. But no surprise, you can see with the little lines underneath, the best one was lithium at 89%. And that's just come down a bit. It's still doing well, 77% this year. Copper and gold on the other notable successes, as you can see underneath. But what I just want to comment on really is the junior miners. They grew 37% last year. Right? And they're down 8% this year. But despite the limited funding that they've had, they've been able to continue to grow exploring. And we expect this because funding isn't there. You'll expect this to continue to fall, and we'll be relying on the majors to do all the exploration. I'll park that there for this data. I'll move on to my final section. And the final section is to consider asset management. BlackRock is just the example I wanted to use it in this example. But we are seeing a similar shift in asset managers' strategy, focusing on energy transition metals, focusing on sustainable mining. And we have worked along with S&P Global Indices, where we support these asset management companies to develop like ETF funds, BlackRock, First Trust, ProShares, all good examples here, where we've helped develop an ETF they're a strategy to target energy transition metals or battery metals. Those have been out there for the last few years, but it's good to see that there is a good shift here in the strategy from the asset managers as well. And this was the key intro of the data that I pulled up. This is institutional ownership, right? So this is showing BlackRock. Their ownership doubled to $70 billion since 2018. That's the bar charts on the left-hand side. And if you break that down into metal, as you can see on the right-hand side, you can see which metals that they've invested heavier into. And of course, I think we'd all not surprised to see lithium there at the top. A much smaller base, over 800% growth there, followed by nickel, iron ore, and copper. Gold was dropped. It's below 100%, 76%. It's rising, but obviously, lost a little bit of its shine. And the other thing to see on this chart, on the bar chart, you can see in blue. This is the ESG rating. It's a score that we build a score for individual companies, and this is the weighted average score of that portfolio that I pulled up. So that blue line just shows that it's been rising. So ESG is obviously important for them to invest into. And the yellow line is just the average for the industry. So doing quite well, dropped a little bit this year, but clearly must be important to the investment portfolio. Now I wanted to see what changes had been made. And I focus on copper, or can't do everything. Excuse me. So their copper ownership. I wanted to look at the corporate weightings. What were the biggest changes I could see? And you can see the table there. There's been a few changes. You can see in green and red. And the biggest ones is the increase in Anglo American, the increase in Freeport, and an exit of Jiangxi Copper. Not entirely an exit, but you can see this shifts the equity production. What that means is that the geographic weighting is actually moving to the Americas, because most of the Anglo and Freeport's assets are North and South America. The only thing to note outside of that, you see Rio Tinto has a drop of 15% copper, but that's just going to reverse because Oyu Tolgoi up in Mongolia is going to ramp up. So there's no change in the equity ownership of Rio Tinto. So it's the other two that I wanted to pick out. And what's also interesting is the far right of that table, you can see the cost curve position. And First Quantum is in Q4. And you can see that what this means is the weighting of the cost position has changed. It's actually moved up. So they've sacrificed their cost position in this portfolio. And it's actually easier to see here. This is a nicer chart. We model these assets, and this is the production cost models that we used. We do profitability forecasts. But this is just showing you the weighted average costs for those companies. And you can see, Q4 on the right where Freeport is Jiangxi is near to Anglo American, just in the middle in Q2. So clearly by investing into Freeport, which the market risk, I guess, of copper may be less of a concern for the investment portfolio. So they're willing to sacrifice the cost position for other benefits. Right? And the only other benefit I look at here, of course, is ESG, as I mentioned. So I'll finish the last slide. I think we've had enough slides. But we'll look at the last slide here. It's a bit messy, but I wanted to simplify it. Look at the top line chart. Anglo-American in yellow, Freeport in dark blue. We have ESG ratings that we build, we update every single year. And you can see that those two lines have been improving. This has most of the major copper producers, and I put in Barrick, another with considerable copper production as well as gold. So you've seen that those two lines have been improving, and investment into those two companies will shift the portfolio, which you can see in the light blue. You can see it's actually shifted their ESG weighting and improved on that. So of course, you know, ESG is clearly important here. It's not going to be the only driver. I'm not going to look at everything, but I thought this would be important for miners, developers, explorers, that, you know, it is going to be really important to pay attention to what, you know, ESG credentials they have to, you know, help attract investors as they plan ahead. As you're planning your development, you know, you're looking at permitting, you're looking at, you know, the local community, looking at the environmental impact, because having a good rating is going to you know, attract those investors to you. So the big chart, which I don't want to spend too much time on this is actually where we look at carbon emissions. And I think it's nice to see the distribution with these big mining assets. On the y-axis, that's your carbon emission compared to the revenue generated by the asset. The lower you are, the better performance you are. The x-axis is the revenue generated, and the size of the bubbles is production of copper specifically. And I just wanted to show that there is quite a range, depending on the region, depending on the asset, that compares these together. But that's all I want to do for this chart. And yeah, I'll park it there. I think I'll end the presentation. This is just a summary of key points. I won't go through that. I'm happy to share this in PDF form. Happy to discuss everyone after this. So if you've got questions, I'll be here. And I'll pass it back to you guys.
Well, thank you for that, Gareth. I think the two key points, and that is not new for us, unfortunately, is number one, the big gap between supply and demand. If we want to reach all of these exit scenarios, decarbonization, electrification all over the world, on one hand, and on the other hand, still the lack of financing to achieve that. And if we come to Europe, I think the situation is even more difficult, because that was on a global scale, what you mentioned. And if we would sit here 2 years ago, everybody was enthusiastic, and we said we have to implement mining in Europe, and we have to do this and this and this, and everywhere from Brussels to Berlin to Paris. They had discussions and nice projects and programs setting up, and now we are here, and we are back in the real life. But before we discuss all that, I think I want to introduce the panel to you. It's a bigger group, and I would say we go from ladies and investors to companies, which is only men, so I do the gentleman style and the structured style. And maybe I start on the left side with Xenia. She works for EBRD. I think maybe give us just a minute about EBRD. I think it's easier when you all introduce your companies and your projects than I do that, and then we go into the discussion.
My name is Xenia Manushis, and I'm I've been in Japan for a long time, 19 years. So it was very much at the beginning of fossil fuel finance. About 10 years ago, the bank blended fossil fuel, and we were slowly going into the mining sector to become the focus of our team. So you saw yesterday already the slides from Polygon Mine. So you know more or less what EBRD is. It's a public institution set up in 1991, owned by 71 governments, as well as European Union and the World Bank. So we do have our mission, our agenda, and we're there to support mining companies in a way that promotes sustainability. We do work as a commercial institution, so we're not providing grants, something bank.
Okay, so one small change on the right side. We have Kate Yannick from Luma Holdings. She is here for her colleague Alexandra, who wasn't able to make it. Same with my luggage, by the way. This is why I'm wearing jeans. My luggage was also not able to make it. Luma Holding, what do we have to know about it?
So good morning. So Luma Holding is a big investor in CE and Balkans, and it invests in variety of sectors, including mining and including metallurgy sector. And this is why I'm here. I'm a representative for metallurgy sector. I work with Luma Holding since 2018. At the beginning with ferroalloy plant in Poland, in Realis, and then I also joined to African project when we produced tin. And we have their tin plant in Rwanda. Also we have some assets in Tanzania and DRC as well. And now we are looking at the transition to going green, both in tin, so green tin project, and also in ferroalloy production, so green FESI, as we call it.
Okay. Gonzalo Landman, he is partner at Synergy Capital, Dubai-based private equity company.
Perfect, you did all the introduction. We're a private equity firm that invests globally in the industrial sector as a whole, from extraction all the way to distribution, as well as enabling infrastructure. And essentially our investment thesis is underpinned by two big trends. The first one is energy transition that we have spoken significantly, and the second one, which is very crucial to the conversation that we're going to have here, is this redevelopment of supply chains that is happening right now. First, as a result of COVID, as a result of the war in Ukraine, and driven by all of these policies that are creating self-sufficient economic units. So very happy to be here and learn more about investment potential opportunities here in Europe.
Wonderful. Now we come to the company side. Right, no, left of me, right from your side, we have Graham Farrer. He is head of sustainability at King's Rose Mining, company with projects in Scandinavia. Maybe give it some more detail.
Yeah, no problem at all. Thanks for having me on the panel, first of all. For those that were not here yesterday, I presented on our projects in Norway and Finland, and what we think is an innovative approach to project development. So being more sustainability focused and bringing in sustainability principles as early as possible into the mining life cycle, with the aim of turning the non-technical risks into opportunities, compressing the permitting timeframe, and ultimately getting more sustainable investment as well.
Wonderful. Marian Urban, country head of Prospect Limited, a company with projects in Scandinavia as well, and in Slovakia. You're responsible for the Slovakian part, but also, of course, aware of the Scandinavian projects. Some insight.
Just a few words, welcome. I'm responsible for the Slovakian side of the projects. It's an Australian-based junior company. In Slovakia, we were previously focusing on precious metals, currently switching more onto rare earth and other critical metal commodities. In Finland, we have a rare earth project and one of the lithium greenfield site. So that's
So I already see that it works. Dennis, welcome. You are now in Kiev, I assume?
Yeah, correct.
Okay, Dennis Aveshin, he is Chief Strategic Officer at ULM, Ukrainian-based company.
Good day, everyone. Good day. Nice to meet you. So we are developing Polokhovsky lithium deposit, which is in central Ukraine. ULM have been developing the project since 2018-2019. Basically, we are going through a fairly standard process like any other such project goes. The only thing is that obviously by now we are hindered a lot by the war, right, in the country. But still we are focusing on the standard development process. We've finalizing the feasibility study now, going through environmental social impact assessment, and basically our hope is that once the war is over, there will be a window of opportunity inter alia for such projects in critical mineral segment, right, when the country will be hopefully rebuilt and reconstructed.
Okay, perfect. Thank you for that. let's go into the discussion. Since me and my company, we are also one of the largest mining investors in Germany. I'm not only the nice moderator, I will also have some mainly critical words about mining in Europe. So let's see how that goes. I mean, it's obvious that we have to increase the mining activities in Europe. Number one, we have to secure jobs. The change from the traditional cars, for example, into the EVs will make a lot of people unemployed, but we can of course replace them when we put them into the battery production, something like that. So that is the reason why everywhere all these battery plants show up, and we also want to have mining. The next thing is the ESG component. Of course, the closer the mines are to the OEMs and others, the better it is. That is also very obvious. The shortage of material makes it necessary that we try to bring everything into production that is available on planet Earth, and there is lots of projects in Europe as well, and we should take that opportunity as well. And then, unfortunately, since 2 years, we have the deglobalization, and we want to, of course, become more independent from China, from Russia, and now rising oil prices because of the second war. It sounds so stupid, but the second war on this planet makes the things more difficult. But let's face it, and I don't know what your experiences are, I don't know how honest you want to speak about it, but from everything I hear in Berlin and Brussels and everywhere else, the truth is that we don't want to have mining in Europe. That's simply a fact, and therefore my first question to the investors on the panel is, you can choose projects all over the world, and you went to Africa, which is a very experienced mining continent with a lot of sweet spots, downside as well, yes, but why do you now try to but why do you focus more on Europe now? Because we are not the only continent that is looking into ESG and other things.
Yeah, so first of all, we are not only concentrating on Europe,
Yes.
or only on Europe or on Africa, so we decided to create some kind of a bridge between these two countries. So I know that team didn't found out on the critical list and strategic list on materials in European Union, but we understand that it actually is, and it's going to be needed in the next years. So we owning the facility in Rwanda, we produce high standard LME quality tin, and we understand that Europe needs to diversify the supply chain of this material in the future. So what we decided to do is to create some kind of partnership between European Union and Africa. In our case, it's not only Rwanda, which is one of the cores of our project. So there's 4 cores basically. So one is going to be the Luna smelter, which is our plant there in Rwanda, to enhance the production, to improve the capacity. Then the second core is to create the first European tin smelter, because we don't have it. We only have some places to produce tin out of scraps, the recycled one, but we do not have anything to produce out of the raw material, which is cassiterite. And then to fulfill the gap between production here and production there, we also decided to focus on investing in mining. We have some projects going on in Rwanda, in Tanzania. We are also focusing on Morocco currently. It's basically in the middle from our perspective between Europe and Rwanda. So that's the main 3 cores of our Green Tin project, as we call it. It's going to secure the supply chain. It's going to secure both investment in Europe, from our perspective, and in Africa. And it's also going to secure from ESG point of view. We're going to transfer the knowledge. We're going to help people to train. We're going to improve the gender equality in Africa. Let's face it, it's also the problem there. So we decided to combine the ESG European standards in Africa, and at the same time to combine African sources to Europe. That's our idea to fulfill it.
I remember yesterday, Gonzalo, when we spoke about it, and I said you want to invest in Europe, and you said, I try. So why do you look for projects here and not somewhere else? Or where do you see the sweet spots putting money into European projects?
I mean, critical minerals in general would be the sweet spot. As I mentioned in my presentation, we're seeing this shift that we need to understand how it's going to evolve in the world, deglobalizing, as you mentioned, and having semi-autonomous regions. And this is policy driven at various stages. including, for instance, pricing carbon. So projects that could be marginal on their own, once you start building up all of these elements, could become profitable. Now the big question here is NIMBYism, and that may further divide Europe into different regions where mining is more acceptable because of tradition, because of population density, because of a host of issues related to ESG. So, for instance, in Finland, in Norway, Sweden, there has been mining for forever, and also in Eastern Europe, countries have been more friendly to mining. So I think it requires a very specific approach of where to find these projects, identifying what set of policies ultimately make a project economic, and also when you're a private equity investor and you start thinking, okay, this project is always only economic based on policies, obviously that raises a lot of questions to us and to the investment community. But assuming that projects hold up on their own, and then you have all these tailwinds that further help them, then those are the type of projects I would be interested in looking at. Having said that, mining is only one portion of our fund. We also invest in mining tech, so there are a host of other opportunities that are available here and justify my presence in this conference.
Okay, I mean, for you it's a little bit more difficult. You run the name Europe, even in the name of your bank, and you have an official mandate, and there's politics behind it. Has something changed in the last years due to the willing from Brussels and all the other capitals to increase mining activities? What does it mean for your daily work?
So, interestingly enough, so every project in the EBRD goes to the board. Yes, where we have 71 countries and the EU and the World Bank, and they all vote for each project, yes? And then they also always have something to say. And if we talk about like 7 years ago, not so many constituencies were very supportive of mining, but more and more, and that required certain education from the team side. Yes, what is mining? Why EBRD should be there? Why public institutions should support mining projects? And slowly we have seen the shift in mentality of the constituencies, because when I say board member constituency, it means that we're talking about Ministry of Economy of various countries. And now also because of the an incredible shift in the EU policies and the focus on critical raw materials, exploration, and the trend in so we were all talking about globalization, now we're talking about regionalization. So that is definitely something where the bank can play a role. We are limited in our geography, so we can finance projects only in Eastern Europe and Southern Europe, if we talk about Europe. This includes Ukraine, but also then we have Central Asia and Northern Africa and Turkey. So if we talk about Europe, Europe does have a rather good mineral endowment, and there were discoveries almost every year. Then the problem is obviously statistics is not great, yes? So it's a very small fraction of projects discovered actually come into production. Then the costs are growing, so exploration budgets are increasing all over the world, including Europe. Also, when the costs are growing and inflation is up, the companies are very careful how they spend money. And in our region, we saw that the main focus is on copper and gold, because this is something everybody knows. And recently, so this year, the bank will approve a new mining strategy. And one of the targets, objective of this strategy is to accelerate targeted mineral exploration. So that means that we will more and more look at the projects in exploration area. We started doing this a few years ago. So in the past 3 years we did 3 equity investments, all of them in Europe. So one was Adriatic Metals in Bosnia, a polymetallic project. Then we invested in European Metals Holding in Czech Republic, which is focusing on lithium project, as well as Euro Manganese, as well in Czech Republic. So those were small equity investments, around, all 3 of them around like 6 million euros, more or less. And they were all done at that stage where typically it is considered risky to invest. So it was just before the bankable feasibility study is issued, so for the final works. And this is definitely something we're looking more and more. It does, so we do have expertise internally. We do have a mining engineer who obviously looks at the resources. We have a very strong environmental department who looks at other issues. So yeah, it started to be a bit long, but I will let more
No, that's okay.
on our approach.
That's why we are here. I know you work since ever in Europe, so to say, in different projects all over the continent. Do you see a change in the whole situation? Do you think it's an advantage to be in Europe now, or is it all just hot air?
Well, I would say it's still hot air. Yeah, I've been working in Cyprus, Spain, Slovakia mainly, and currently Finland. And yeah, we had discoveries in the previous company in Slovakia, which was a significant one, but it was on hold because of the permitting issues. So yeah, there is a lot of talk about supporting on the European level, but when it comes down to a very local level, local governments, there seems to be a more political and social license risk rather than support. And yeah, so I would say it's pretty even, not improving at all. Maybe nowadays with this raw material initiative will be more like going down support for the local governments. But we'll see.
And Graham, you have been able to, your company is public, it's listed at the Australian Stock Exchange, even that you have only European projects. My personal view is that the Australian Stock Exchange is becoming a very weak source for fresh money. The Australians are over-invested, and there's lots of smaller investors, retail investors, who have, of course, as we all know, yeah, they struggle with inflation, all that stuff, same that we do, but their private balance sheet is very much equity dominated, not like us here. Is there any plans for you to attract European investors now? Do you think that this is a source that wasn't available for decades, but is that changing? Is there more and more European investors coming to you and looking into it, or is it still the typical mining investors from Australia, from Canada, and maybe Switzerland?
Yeah, that's a really good point. I think we are seeing more interest from Europe. We're also seeing a lot more interest from the major mining companies looking to move into Scandinavia. I'm not going to name names, but we've had 3 majors go through a drilling project in northern Norway in the last month. So there is a lot of interest, and these companies are trying to come in and set up a footprint, which I find really fascinating. In terms of European investors, I don't think I'm too exposed to that, but there certainly is more interest. I think the history of being ASX listed is we once operated a gold mine in Indonesia. So that's a legacy of our company history. And we've had lots of conversations about this, and maybe there are a lot of benefits into being somewhere European listed to show our commitment to the region. So that's certainly something I'll be discussing with the CEO when I get home.
Fine. So let's go back to Kiev. Dennis, do you still hear us?
Yes, I'm here.
Okay, I mean, we all know about the situation, and it's, I mean, it's very unrealistic that you receive huge money inflows in these days. But is there things in the background for the day when the situation is easing up, and are you in talks? Is there people in standby? I mean, we all know that the Ukraine is rich of all kinds of minerals, And so, do you prepare yourself already? Is there things you have on hold and standby, or is it just hope?
No, look, we are preparing, obviously. We are lucky enough to be owner-financed, so basically we do not need to go to public markets, grab some relatively material amounts of money to continue with our development program. We finance that on our own in-house, but at the same time, even now with war, there is a lot of interest from strategic investors. I do have some communications. Obviously, whilst the war is there, no one will be investing large-scale money into this project in Ukraine. That is apparent, right? But we are trying to also to speak what are the possibilities in terms of war risks insurance. We're having some communications with the respective agencies that are already doing that for Ukraine, insuring war-related risks for foreign investors. So we're definitely not sitting and preparing for the situation when the war stops, and we could turn from, from the development path into more like detailed engineering and hopefully construction. So there is interest because the deposit is fairly large for Europe. There are not that many lithium projects in the European Union at all, let's say. So if we compare the supply and demand sometime at 2030, then basically European Union is going to be needing something like 24% of global lithium available, whereby the European Union allocated deposits and companies' operations shall be producing only 4%, right? So it's 6-1, and that is something that gives us hope that this operation will be needed by European Union investors in particular.
Okay, thank you. Gareth, do you have the chance to give us a bit more detail about your presentation was on a global scale? Can you give us a bit more information about the financial market situation in Europe? Is the investment increasing? From which sources is it coming? You have some brief bit of.
I mean, I haven't pulled up these numbers, but our clients in Europe, there is, especially the UK, where there's a bigger market to raise funds for the mining sector. I mean, it's traditionally looked at around the world rather than Europe. And I guess there's a number of our clients that have switched their attention to Eastern Europe, where there's a lot of resources. And I think the problem we see is that the resources that are there are quite a lot of them privately controlled, with difficulties with permitting, passing environmental regulations to see them develop. So I think it's been very slow. I think it's more there is interest there to deliver this because there's a need for Europe, but a lot of the attention is on how to grow your own production and resource base as quickly as possible, right? For the benefit of securing a balance sheet, for the benefit of bringing production online. So I think the story, and a few people have sort of mentioned, is still relatively flat in terms of how much money is coming into Europe specifically for this. I think it's more of an interest to do it, perceived for to build something that's close to home and benefit from and the advantages around that. But I think, although I haven't pulled out the end of the numbers, I don't think they're going to tell us a big change, not as yet. In a year or so's time, we'll maybe see more of those maybe start to benefit.
I think the biggest problem is that the early stage investments, they are too small for the big banks and too risky, and the whole exploration business still has its reputation. That's something that the traditional European investor still in mind when he thinks about mining. All these cowboys and blue sky companies and issues at the border to the Ukraine, like we heard yesterday. That's not what the people want to hear. That's one of the situations. For the big ones, we are close touch with Deutsche Bank, for example. They want to have 200 million project investments and not 10 million exploration investments. That's a big thing, and the typical exploration investor is friends and families and moms and dads, and they're overinvested. That's a problem. Coming to the know-how of the investors, I think one of the biggest problems is one of the biggest problems. I think the mining industry is the biggest industry in the world with the highest R&D expenses everywhere in the world, but in Europe, which means the Europeans compete with a lot of know-how somewhere else, which is unusual for us. And for example, in the OEMs, people now buy lithium, and they have bought tires and lamps and stuff like that before, and when they ordered 500 million tires for November 17th, they got them on November 17th, and if they now order lithium for February 2025, we all know it will be 2027. And that is something where we see that it needs a lot of improvements, that these people do understand how it works. And when I speak to people, they usually think it's kind of Minecraft. You walk around to find something, you buy equipment, you mine, you make profit, and everything is fine. But that's simply not the fact. And I have in fact also a story. There's a gentleman in Germany called Olaf Scholz. He is the chancellor of the country. He flew with a group of delegates to South America to secure lithium and other critical minerals for us. And on that flight, in the air, on that flight, he learned, he's the chancellor of a country where every 6th or 7th job is related directly or indirectly to the automotive industry. On that flight, only 6 months ago, he learned that you cannot mine the lithium and put it in the battery. It's not like gold, where you mine in the morning and in the afternoon you have a ring out of it. So we all know that the mining of the lithium is the easiest, but the chemical process, that's the difficulty. That's where it's dependent. We didn't know that. We simply didn't know that. So that's my story about that. So on the company side here, and maybe we start in the Ukraine again, Dennis. The European investors, especially the strategic, the corporate investors, do you see them on the same levels like the experienced Canadians, Australians, Africans, whatever, or the people who are the new kids on the block, the OEMs and others? Do you think that they are able to, because we saw a lot of desperate investment from the OEMs in Europe the last couple of months, do you think that they are on a level that they really understood what's going on?
Look, I agree with your point, and to put it mildly, there is a lot of learning curve to be done for them in Europe, like in Europe at large. Because basically, if we look at the lithium industry as such, it's it's a novel thing. It's like the whole brave new world, right? So it's only like 15 to 20 years. And basically, for the first 10 years, China was definitely at the forefront of that industry, right? And you can take very simple statistics. So if you, I also agree with the point that, that you've made, that it's not only about mining, although I would not probably agree that mining is that easy, and actually most of the deficit now and going forward especially will be in the upstream specifically. But when we're speaking about conversion, there is a very simple fact, right? The capital requirements, capital cost for the converter is China. In China is usually 3 to 4 times less than it will be in the Western Hemisphere, right? Now we have only got, and there is another very simple statistic. In China, there are 50 plus converters running already for 10 plus years. If we take Western Hemisphere in large, there is only one operating converter, and that is Upper Marley's converter in Australia, right? So it's pretty much same thing with the concentration, because there are 6 to 7 running concentrator operations, all of them in Australia, one of them in Brazil now, maybe 2 of them in Brazil actually, right? But most of that expertise, most of that competence is in China. And now, so here is the ladder. You've got China, where most of the technologies are for the long time, and they are, especially when it comes to the conversion, they're much more competent and experienced, right? Then you've got Australia, not so much Canada, because most of the projects in Canada now are still like junior miners, as opposed to Australia, where you've got both concentration and conversion already like running most of it stable state in terms of concentration, right? So obviously a lot of such practical, technical and technological experience is in Australia. And frankly speaking, Europe, and actually same as in the United States, but European Union has got a very long way to go understanding this business, right? Understanding how it could work, and specifically how it could work in the European Union. Because when you look at, when you look up the value chain, when you look at the gigafactories, there are like something like 30, there are a lot of gigafactories that are and will be operating in Europe. But how will the supply be procured for such gigafactories? That's quite a question, I would put it mildly again.
That's true. Ryan, what's your experience with the new investors coming from Europe?
We don't have many. Most of our investors were from the other side of the world. In Australia, recently we've been exposed to European investors. So that's fairly new to me, and I really can't judge the exposure to European investors.
Any idea from your side? You don't have that many investor contacts so far.
No, not so far. We're very fortunate because when we divested this gold mine in Indonesia, we made a significant profit. So we have a good slab of money in the bank, which means we're funded for the next few years of drilling. But there will be a time where we need new investors, and depending on our progress, that might be sooner than what we expect. Our third largest shareholder actually is based in Switzerland. He's a British guy.
That's not Europe. That's not Europe.
No, it's not Europe. Okay, no problem. But I think we need to start increasing our exposure, and a key part of that is ESG, and aligning ourselves with strong ESG credentials. But the way I've been explaining it recently is it starts with sustainability. If we can't get access to our ground, and we can't get permission, and we don't get our permits through, then ESG doesn't matter. So if we're sustainability led, as that matures, the ESG credentials will come out, and then we can align ourselves with what I consider to be a whole range of new investors. And that's something we're working on over the next 3 to 4 years. These things never happen quickly. I've only been at the company less than 6 months. I can't remember if it's 4 or 5. But these things take time, particularly keeping ahead of an exploration team who is very, very keen to get in and drill holes as soon as possible. So I think that's probably the next phase of our company, and the way I see it is accessing these more sustainable investment options, and accessing more European investors in the future.
Okay, from an investor point of view, I assume that your investment process, your due diligence, is a very well developed process over the years. And is there a big difference when you enter into that process in mining friendly and experienced areas like Australia, some of the African countries, and when you now go to Europe? Or is there, would you say it's almost the same? Did we learn from others, which is difficult in Europe?
I'll say it differently. So I don't have experience in Australia. I can talk about Africa, and that was difficult. Honestly, when you compare Europe and how we are prepared in Europe, how we have an access to data, how we're collecting data, how we are in really good relations, in contact with every step on the line. And then you go into Africa, and it's really difficult to do anything. Especially that Rwanda is located by Dodd-Frank's at Kara region. Kara region means that it's a high conflicted area, and whatever we do, we are triple checked. Whatever we are supply, we are triple checked. So we needed to in the past, and we need to now ensure that whatever we are taking, whatever we are collecting, cassiterite or any other raw material, was possessed by really high standards. And we faced the problem at the beginning when we placed it in 2018, and we were looking for a solution to have an option to collect the data, to track the data, and then to spread the data, because we get the material, and what's next? We want to produce something, and when we produce something, we want somebody to buy it. And somebody who is buying it, especially in Europe or in Japan, for example, or in the US, they want to see that the product we are having was done by legal way, let's call it, simplify it. So I think I want to talk about blockchain here a little bit. So what we did, we were looking at MINEX company, who together with Minsur and Google created a blockchain platform in 2020 in Peru. So we decided to implement it as the first one in the teen industry as well. So the blockchain platform gives us an option to collect the data and then transfer the data from us, from the bottom, up to our customers. So it looks like this, that we are collecting all of the data. We have 3 different layers of information which we can share. It's a private layer between us and the customer directly only. They have the access. Then we have a public layer when whoever is on the line, whoever is in the chain can access to it and check some information. And then we have a transparent layer. So everybody who scans the QR code can get the information about some regulations, some permissions, some certification from our side and the customer side. What it's giving us confidence for our clients about our information, because we had to check it. And at the same time, we are secure that the data gonna be okay from the whole process. Nobody gonna interfere, nobody gonna change anything, which is really crucial for our case in Kara region. So that's how we collected it. And then, coming back to your question, there was nothing when you compare it to Europe. And now we start to work on it in Rwanda, and it's working really well actually. So we start to cooperate with other companies to implement some kind of gathering the data, sharing the data, working with us, working with other miners, suppliers, etc., etc. Because if we don't have the data, then we cannot spread it further. If we cannot spread it further, we actually cannot grow as a company. That's
Okay. From your end, do you see different challenges in your investment process in Europe and outside Europe? Is it more difficult here? Is it more structured? Is it more modern? Is it all the opposite?
So the only investments we've made in Europe were on the industrial side, so we're pretty safe there. On the mining jurisdiction and location is, if you saw my list yesterday of my Christmas list of things needed to produce a mining unicorn, the first thing was location and jurisdiction. And that is crucial. And it is not at the national level, it goes beyond that. If you check the Fraser Institute data, you see that in many cases they go state by state. And from my experience, I'm from Argentina originally, and there's some provinces that are very pro-mining in the north. But if you go to the southern part of the country, there's no chance to get anything built. And the same applies here. So you cannot talk about Europe as a whole. You have to be much more granular than that. I hope that answers the question. I do think, taking a point from you, that there needs to be new talent coming into mining. Generally, there needs to be a leapfrog programming mentality. When I was last week in LME week in London, there was this discussion. It was I think it was the CEO of Tech, and he said how he had hired a number of data analysts. And they put them in a very nice office that looks like Google and has all the nice things that they do have. But what they were offering was something that they could make a difference. So they would create these Scrum teams and go and improve production or solve potential environmental problems. And that is a way that the industry can really attract new talent that thinks differently, that has a different speed, which is crucial. To get results done.
And the EBRD, since the stakeholders are governments and others, do they listen to you? When you say, okay, look, in Australia, for example, or in Canada, it works this and this and this way, it's proven and investors like it, and why do you do it different? And are you part of that? The CRMA, I mean, it was a highly celebrated event, a shortage of application time and all that stuff. Are you part of that with your practical experience, or?
So we do not impact in any way any regulations or any acts in the EU or anywhere else. But the bank does have various initiatives which involve governments. It is called policy dialogue. So very often in various countries, we do engage with the governments and try to assist them in changing their legislations and regulations in such a way as to attract investors. Because obviously business environment is the most important factor for any investor. And it's interesting what Gonzalo was saying, yes, about Google Office and everything. It actually shows, yes, that the sector is becoming sexier, yes, and new people are coming. And there is hope for lots of innovation to come, but obviously all structures which were there, they remain, and they have to be amended, changed, so that they reflect new times. And what we see working together with our potential clients or existing clients, legislation and regulation remain a big obstacle, and very often it's due to the lack of resources, human resources and funds. So there is a need for, I don't know, European Union or also various development banks or institutions like us to provide funds and also trainings maybe to build capacity of these institutions. Then also land acquisition remains a big issue because it differs in all countries. In some countries it's clear how the process should be, in others it's not at all. And that creates lots of traction between local communities and potential investors. And that's where actually the company should be very proactive in a way as to install a dialogue. And Graham spoke yesterday very well actually about the work that the companies can do. And lots of patience is required, yes, but there is a saying which is very popular these days, not in my backyard. So in Europe, which is pretty densely populated, nobody really wants, to have a mine next door. So an investor and the company has to deliver the message that it can bring lots of benefits. Yes, benefits in terms of money to the local communities. It will create new businesses, work opportunities, of course, and the companies should also think about how they can support this, maybe with some foundations, cooperation with local authorities, because if the message is delivered well, it will produce faster actions, in order to get the permits, and right engagement will give a green light to a good development.
Thank you. So now, Christmas time is coming up. You already mentioned the wish list. On the company side, Europe is trying to implement.
Can I make a quick intervention here? So another interesting discussion I had last week was with was the former marketing head of Barcelona football team, Barça, and she was.
We're talking.
Now we're talking. Okay. So she was critical in terms of changing the perception of the positioning of Barça from being we're the best to we are the favorite. And a result of that, they ran this global poll, and they got 130 million fans that said Barça is my second most favorite team. And it was brilliant. So now she was hired by one of these institutions representing women in mining. And we were talking and trying to find a way to reposition mining into something cool. So having the same shift in Barça saying, okay, we're the best, and then you're basically compared against Real Madrid all the time. And if you win, you're fine, and if you lose, everything goes to hell. Into we are the team's favorite. And so if this is, I am asking questions. If you have any cool idea of how to position mining, please let me know, and I'll share it with her. One of the key points there, we were saying that mining is like alchemy. So transforming rocks into gold or something that is valuable. But again, I'm very open to suggestions, and it would be great for the industry as a whole.
It should be an own session, I think. So, yeah, coming to the future and on the company side, I mean, the Europeans, they try to do a lot to attract mining investments and to increase mining activities in Europe. Is it enough? What would you say? I mean, is there something on your wish list where you would say we need some upgrades here, changes there, and this goes in the complete wrong direction?
Well, currently there was a good thing about this for us as a company to attract more attention with this raw material initiative, which is live now, which basically shows the real interest on raw materials. So that was a good move. Obviously, it's just a signal for the investors. Hopefully, it will reflect our investor base and our projects to get a better financing. And that's what I would wish.
On your end?
Slightly different and probably a little bit controversial. I was in Brussels and talking about the Critical Minerals Act. I was told it's not going to be of any use to us for at least 5 years. That kind of reinforced my thinking that our challenges are not with the regional governments or the national governments or even the local governments. Our challenges are with the people. Whether they be individuals, communities or NGOs. And I think this is consistent across Europe. I've only worked in mining in Europe for 5 years, but every one of those projects I've worked on has had people challenges. They're supported by the government, they're supported by industry, but there are a small percentage of people that are very loud and pushing back against these projects. So we talked a bit yesterday about the power of storytelling and building on what you said before, Gonzalez. I think the industry has a reputational challenge, and I think collectively we need to try and turn that around. But also at a more local level, having patient investors and investing the time and resources to appropriately communicate what mining is and what exploration is, and what are the negative impacts, how they can be mitigated, and what are the benefits and how those benefits can be maximised. So I think no matter what changes in legislation or government approval or municipality approval, we are still going to have the people challenge. I come from an environmental background. I much prefer to deal with environmental challenges because they're tangible. There's a permitting process, you have to go through that process, you complete the studies, you complete them well, you spend the money, you get your approval, no problem. It takes time, but you can get there. When it comes to people, they're very dynamic, very difficult to understand where their concerns are coming from, let alone address their concerns. So that's going to take a long time and a lot of resources, and that's our focus right now. I think the government will be the government. They're behind us, they're supporting us. We're actually, it's a really mining positive region, but until we can turn around those people, whether it be NGOs or Indigenous people or communities, to understand that we're not there to destroy the land. That's mining of the past. We're there to extract resources that are essential for an energy transition, but we will not do that unsustainably. We'll partner with you, we'll share the benefits with you, and let's develop this together. And that's a really, really difficult message to, first of all, develop, but even more so to communicate.
Thank you. Dennis, back to you.
Yep.
I mean, we all know your wish number one, but is the company, the country prepared for that day? Do you have enough manpower in the country? Because we all know that when it's possible, a lot of money would go into the country into mining investments. But do you have enough manpower, enough experts? Is there experts working and supporting you? I mean, lots of you people are in the army now and all that. Or is there? Are you well prepared for that day?
Look, that is quite a complex question. So basically, for economy as a whole, definitely there is a very big issue of like something like 6 million people left the country because of war. Men left the country as well. So I mean, there will be definitely a shortage of labor going forward, even after the war is over, because you know, now most of the male population is in the country because they are effectively prohibited to leave because of the wartime restrictions. But once the war is over, and also depending on how long will it take for the war to be over, you know, some of the guys would want to just leave the country and reunite with their families who had already settled in Europe, one option, right? So the country at large will need to do a lot in terms of policy to facilitate people coming back, right? And actually economic policy will be amongst the major blocks related to such a facilitation. So, I mean, like, even if I put the war, you know, let's imagine the war is over, Ukrainian government has developed very efficient policies which have facilitated return of most of the people. Now in this business, in lithium business, there is an issue anyway, even regardless of the war, right? Because I think in every jurisdiction there is now a fight for human capital related to such which is required by such sophisticated operations, right? When we take the upstream, mining and concentration is not that sophisticated, but if we are speaking, let's say, lithium chemicals conversion, right? So if we are speaking about the converter potentially within Ukraine, then here you cannot be doing it without having an expert team, right? And even now at our development stage, I obviously, you know, we do have quite competent in-house team. We've got geologists, processing specialists, technologists, etc., mining guys. But I also have a number of expert teams working for me, right? I have one team who are my own as engineers. When I work with all of my other international counterparties, they are assisting me, and they've got practical 100+ years of specifically lithium experience in Australia, Africa, etc. And also I've got I've got a guy whose name is Anthony there. Anthony is assisting us as senior strategic advisor. Anthony used to be CEO and managing director of Galaxy Resources. He's been developing Galaxy from 2010 to 2020. Then Galaxy merged with Oracobra, that became known as Allchem. Now Allchem merged with Livent, right? And that is the top 5 lithium player in the world. So Anthony is assisting us with the strategic development, right? Which part of the value chain we go to, whether we go for carbonated hydroxide. And I think that is absolutely imperative to have someone like him on board in your team, because without guys like him and the owners, engineers team, etc., just on our own, we simply do not have competence to look at this complex operation, let's put it that way.
Wonderful. Thank you very much for that, and thank you for joining us. We continue to cross fingers for you and your people. Hopefully to see you in person at some point. Thank you.
Thank you.
So, I know you are on the run. Do you really believe we will have a mining industry in the future in Europe again with, I don't know, 10, 15, 20 operating mines producing what we need in Europe?
Well, I really hope so, yes, because considering how many interesting initiatives are coming on stream from various organizations and countries. So I probably the last thing, I'm sorry, I have to leave a bit early, so I won't have an opportunity to talk to anyone outside the room afterwards, but to look out for alternative supports. So like, for example, only yesterday I learned about BHP Explore program. They will definitely tell anyone who is contacting me about, have you seen it? Have a look. So similarly, like for example, only recently I saw in the news that French government put a fund specifically for mineral mining, which is 2 billion euros, and apparently they will finance 10, 14 projects next year. I don't have the details, but have a look, yes, look around. Similarly, an organization which is called EIT Inno Energy, which is like a business accelerator in sustainable energy. But they do, for example, they did participate in one of our projects in Neuromanganese. They provided a grant. Okay, it's not exactly a grant, so they get small equity in the component, so it's only 250,000 euros, but it is quite, it's money, so you can use it for certain studies or something. So my advice would be continue to Google, funds available, grants available, subsidies available, and obviously EBRD is there to support maybe at a stage which usual ordinary commercial banks are not yet ready, but maybe they will be soon, so good luck.
In addition to the French fund, the Germans have been invited to join, but our Minister of Finance didn't find money somewhere for that. Not a billion. So thank you very much. I know you have to run.
Thank you very much. Thank you, Stefan. Thank you, panelists. Thank you.
Gonzalo, there is not enough product in Europe, even if every single project would go into production. In the past, especially in Africa and in South America, in the countries that have been colonized, we used the very low labor costs, and we had mines on ESG levels that didn't exist. And for the cheapest costs, we mined the product and shipped it to Europe, to America, to Asia. That has changed now since all these countries have realized that the mining itself is not the biggest part of the value chain, but the conversion is important. And for example, Chile has nationalized the lithium business. Mexico has done that. Others will follow. What do you think? How will a value chain look like in the future? Ideally, what will happen in the mining countries? What part of conversion will happen there, and how will it move? And will all these battery plants in Europe be fed with product, or is this all just a dream?
No, I mean, you mentioned there are a few more instances. You have Indonesia as well, restricting exports. In the case of lithium specifically, one of the reasons there was a lot of new supply coming on stream last year or beginning of this year is direct shipping ore from Africa, and that has supposedly stopped. And even from an ESG perspective, the idea of shipping ore that is 1% lithium instead of doing sulfate that is 30% lithium is staggering. So what I would see is that there's intermediate processing in these areas, and at the end of the day, you need a local market when you build a battery plant. So therefore, I think that most of the downstream can still happen in Europe. But if you are, I don't know, a hydroxide producer, etc., then that's when you have to think whether you have to be in Europe or you have to be in some of the other parts of the world. I think that on the lithium side, again, probably a concentrate will reduce in the amounts that is shipped. There's going to be plants built in Australia, in South America to do sulfate. On the brine side, you can do a lot of more processing also in the countries like in Chile or Argentina. And the same applies to other metals, I would think. So the answer is yes. The end, the most tech-driven, high capex, closer to market elements will happen in Europe for sure. And then as you move upstream, it becomes a little more gray.
I think that is exactly your strategy, but I understand you right, since you want to build the first tin converter here in Europe. But the money that remains in Africa, will be more money that remains there, since more parts of the value chain will be in Africa. Do you see that, that's a responsibility for you as well, that the money does not go in the wrong hands in Africa? How do you deal with that?
So actually we have this, in June this year, there was European Rwandan Forum happened in Kigali. So we have this discussion that, what you said, this is really important to increase the processing hub located at the place when everything is happening. To do not drag minerals out of the country, to enhance particular countries, and do everything that's possible within the country, and then the final product should be exported. So that's what's happening, for example, in Rwanda. There is other countries in Africa which has a problem with that. We can mention DRC, obviously, because of the, let's say, tensions there, let's call it that way. And it's really important to have big support from the government on each country, but also to be sure that the government, I don't want to go too far, but I want to say that there is countries and there is governments that are not too honest, I would say, yeah. And we are lucky then that was one of the reasons we chose actually Rwanda, because of the really anti-corruption and like really transparent approach to the investors from the abroad. But to have the funds within the country, you have to have some support from the government of that country. That's 100% sure for that.
Hey, I think we come to the end of that session. I learned that there's a lot of money available at some point, which is maybe on the sideline, like we learned from Gareth. And I think the best thing to move things forward is to be successful, and hopefully we will have a few projects going into production as soon as possible to show that we can do mining in Europe. I'm not really sure if that happens. It's your challenge, gentlemen. We are here to finance that, and you will join us with statistics. But I think that was a really interesting discussion, even that it was not really enlightening, since we are somehow turning around since 2 years. But I mean, it's lots of consultants here as well in the room that shows that there's a lot of need to consult the big ones, the investors, as well as the strategic investors, the OEMs. Not sure where we are when we are coming back in 1 year, but we have it partly in our hands. So thank you very much and enjoy the lunch break.